Dear friends, welcome to PMS Insights. While there is some pickup seen across pockets of stocks in the Indian market, the broad markets are still down around 20 to 25% on one-year basis due to the impact of COVID-19. While China is scraping back to normalcy, other major economies are still fighting to flatten the curve. The recent waves of fear and panic has led to extreme volatility in the equity markets. While we appreciate the risk of health and lives of people worldwide and expect most people to be fearful, we expect these market turns are perhaps the best opportunities one can cite. Historically, investing during these volatile times has rewarded investors handsomely over following 1 year and 3 year period. Periods like these are opportunities to cherry-pick quality businesses which have been facing market turbulence but remain strong fundamentally. While the price movements have been sharp in the last couple of weeks, we have been buying selectively and are keenly observing the behavior of the markets. In our view, we expect few trends to play out in the next few months, some of them being faster recovery in businesses levered to rural versus urban sector, faster rebound in low-ticket discretionary items versus high-ticket purchases, and cash-rich businesses could come out stronger from the crisis. Also, this could provide structural opportunities for few sectors. For example, many countries are moving or seriously contemplating to move their manufacturing bases out of China. India must capitalize on this opportunity, and few Indian industries like chemicals can be beneficiary of this move. Keeping these trends in mind, we have made few incremental changes in our portfolios. I would like to highlight few reasons why we would be buyers in equities with a 3-year perspective. Number 1, valuations. We have seen a very sharp correction in equity valuations over the past 4 to 6 weeks, mainly due to selling by FIIs. FIIs have pulled out nearly $16 billion as of 20th April from India since the beginning of the crisis. Historically, a sharp FII outflow has often acted as a catalyst for significant market correction, thus giving us an opportunity to buy as seen in the chart. Second, market cap to GDP ratio. Market cap to GDP ratio has corrected sharply and it is at its lowest since FY10. As seen in the chart, the market cap to GDP ratio has fallen swiftly from 79% as on FY19 to 58%. Much below long-term average of 75% and closer to levels last seen during FY09. The ratio has been quite stable over FY15 to 19 in the 70 to 80% band. The lowest we saw in the last 2 decades is 42% in FY04. Third, earning yields by bond yields, which have been highest in a decade. In these turbulent times, the relative attractiveness of equities versus bonds is increasing. As seen below, EY by BY ratio is comfortably above its 10-year average, thus making investment in equities attractive. Fourth, crude oil prices. The sharp fall in crude oil price led by the global demand shock bodes positively as India is overly reliant on oil imports. As per estimates, every $10 per barrel fall in crude oil prices boosts India's growth by 25 bips and pulls down headline inflation by 30 bips. India imports about 110 billion worth of oil. In this backdrop, the savings for February-March would be in the range of $10 to 15 billion. Coming to our portfolios, Core Equity Portfolio is a flagship offering which is multi-cap oriented. It is a concentrated portfolio of 25 to 30 stocks which have sustainable ROEs and earnings growth, high quality balance sheet and minimal to no leverage. Currently, around 75% of the portfolio is invested in large cap stocks. Select Sector Portfolio is a mid and small cap offering. It is a concentrated portfolio of 20 to 25 stocks across 4 to 6 sectors only, which have sustainable ROEs and earnings growth, high quality balance sheet and minimal to no leverage. Currently, around 65% of the portfolio is invested in mid and small cap stocks. India's Special Opportunities Portfolio, which is abbreviated as ISOP, is a multi-cap offering. Around 65 to 70% of the portfolio is invested in companies that are primed to benefit from catalysts. The catalysts include micro turnaround, macro turnaround, management change, deleveraging and demerger. The rest 30 to 35% is invested across secular growth companies. Currently, around 60% of the portfolio is invested in large cap stocks. Innovation portfolio is our portfolio offering which focuses on the companies that continuously innovate and are expected to benefit from these innovations. Innovation can be across a company's business model, product offering, or customer experience, which results in higher share of new products or services, market leadership with restricted competition, global market leadership, cost leadership, and strong brand recall or customer engagement. Currently, around 65 to 70% of the portfolio is invested in large cap stocks. Coming to our portfolio positioning, we are positive on the large private banks and insurance companies in the financial space. Select companies in the FMCG, footwear, paints, cement are also expected to do well going forward. We have a decent pharma exposure across our portfolio, which have positively performed in these testing times. It all boils down to the fact that never let a good crisis go waste. We strongly believe that one should take advantage of this opportunity and invest now to generate strong returns over the next 3 to 5 years. Our portfolio is expected to benefit on account of exposure to high quality companies with strong earnings growth visibility. Thank you.